Hello and welcome to this video where we will get to cover margin of safety and operating leverage as well as examining cost structures. So for the margin of safety problem, it's heavily based upon break even. And if you looked at the previous video, I told you that we would only do a portion of 3-40 because the second half of this problem included margin of safety. The formula for margin of safety is my current sales level or my expected sales level minus the break-even point. So we already needed to have calculated break even. Margin of safety can be expressed in terms of units. It can be expressed in terms of dollars. It can even be expressed as a percentage, but it does represent the cushion a company has. It's how much their sales can fall by before they start to suffer a loss. Because even though we calculate break-even point is all about covering our costs. Most companies are not simply operating at their break-even point, they're operating above that break-even point. So we want to know that cushion. How much can our sales decrease by before we actually start losing profits or not having any profits? So just to revisit the Northampton City Tours problem, remember the company was offering tours and they needed to offer 45 tours in order to break even. So now that brings us up to speed for B. The owners believe that 50 tours is a reasonable forecast. So remember, when calculating margin of safety, it can be the current sales level or the expected sales level. It doesn't have to be actual hard numbers. It could simply be an expectation or a forecast. But 50 tours is a reasonable forecast of the average monthly demand. What is the margin of safety in terms of the number of tours? So let me scroll down because I have all this information from when I did the previous problem. Let me put the margin of safety stuff over here. So with margin of safety, it is equal to current / expected sales minus break even. So of course you have to calculate the break even point first. If and unfortunately you do the break even incorrectly, then your margin of safety calculation will be incorrect as well. So now we're going to express this in terms of units. And then we'll do dollars, and then we'll do the percentage just for fun. The problem only asks for units. All right, so I know that my current or expected sales level is 50 tours, and I'm going to subtract from that the break even that we calculated from before of 45 tours, giving me a margin, I forgot to type, of safety, a margin of safety of 5 tours. Let me correct that. Margin of safety. So if we're expecting 50 tours, and we're at 47, we still make a profit. But if we're only at 42, then we're going to have a negative or a net loss. We're not going to have any profits at all. Let's look at this in terms of dollar sales. So for margin of safety, in dollars. Now for this one, I have to take the 50 tours and multiply them by my sales price of 350. So that's 50 times the 350. And all of that gets subtracted from our dollar sales, which we found down here to be the 15,750. Now for this one, I gotta do a little more work because I don't know what I should know. Let's see, I have a guess. But I always go wrong when I try to do math in my head. Oh, I forgot my parentheses. Let me add my parentheses in. And then all of that is minus 15,750. So 1,750 is my margin of safety. Now, I can always do the check again because I can simply take the margin of safety in units and I can multiply it by the sales price. So if I do 5 times 350, I still get 1750. Just make sure you're comparing apples with apples and oranges with oranges. We certainly would not want to do 50 tours minus 15,750. You're going to get a negative number, and you should not get a negative number for margin of safety. Now, let's see the margin of safety in terms of a percentage. Now here my formula does change a little bit. It is the margin of safety divided by the current or expected sales. So again, you have to make sure you're comparing apples with apples, oranges with oranges. We can do this in units or we can do this in dollars, but we're still going to get the same answer. So let's do it in terms of units because I know that I have 5 tours. Oh, hold on. So I can take my 5 tours as my margin of safety here, and then I can divide that by my current or expected sales level of 50 tours. And now I can say sales can decrease by 10% before I have to worry about losing any profits in terms of going in the negative. Of course, I'm not going to have as many profits or as much in profits as I had before, but in terms of being able to cover my cost, at least I'll still be able to cover my costs and make some type of profit. So you have it, margin of safety. It can be expressed in units, in dollars, or as a percentage. Now let's take a look at the operating leverage problem. So we're going to look at 3-36 now, where we look at operating leverage and the different cost structures. Now this one is loads of fun, and I'm probably going to change my formatting just a little bit because the cost structure or the format that we are asked to use is simply a contribution margin income statement, the same contribution margin income statement that you saw back in chapter 2. The only difference is that now we have a column for percentages. So we're going to look at those percentages. But if you remember that this is built on that contribution margin income statement, then you'll know exactly where to go if you're asked to do an analysis of cost structures. So in this example, we have the cost structure of Dennis Retail Mart, and it's dominated by variable costs with a contribution margin ratio of 30% and fixed costs of $60,000. Every dollar of sales contributes 30 cents towards fixed costs and profit. The cost structure of a competitor, Oakfield Convenience Store, is dominated by fixed costs with a higher contribution margin ratio of 70% or 0.7 and fixed costs of $540,000. Every dollar of sales contributes 70 cents towards fixed costs and profit. Both companies have sales of $1.2 million for the year. So we're going to compare the two companies' cost structures using the contribution margin income statement format. And then we're going to suppose that both companies experience a 20% increase in sales volume. We're going to actually calculate what their new profits would be without having to recreate an entire income statement with the help of operating leverage. All right, so let's go ahead and set up our table so that we can see a contribution margin income statement. So I have to resize my columns, which I did not do ahead of time. For presentation purposes, of course, when you're doing your homework, you're not going to have this issue of having to resize columns. That format is all going to be there for you. but it's always helpful. As you're viewing things, to see information presented in a certain way. Now, I'm trying to remember how I want this to look. So I'm probably gonna have to go back and change something. All right, I know that a contribution margin income statement starts with sales. And then I subtract my variable costs to find the contribution margin. That's why it's called the contribution margin income statement. But essentially, it's an income statement that formats our numbers based on behavior or classifies our costs based on behavior. So rather than having product versus period, we have variable versus fixed, which brings me to the next item, fixed costs. And then that brings me to my operating profit. Now, we have to do this for Dennis. And we have to do this for Oakfield. Now, I'll go back and make that nice and neat and pretty and centered later on. Now, for sales, let's just work with Dennis now. I know Oakfield has the same amount of sales, but let's just deal with Dennis and deal with what we know. I know that Dennis's Retail Mart has sales of 1.2 million. And this time, I'm definitely going to need commas. There are a lot of zeros. But I don't need pennies. I'm probably increasing it, so decreasing it. There we go. Now, my variable costs are not given to me, and that's okay. I'm only dealing with what I know right now. We were told that there's a contribution margin ratio of 30% and fixed costs of 60. So I know my fixed cost of 60,000. I don't know my operating profit as of yet. So I'm missing a little bit of information, but I was told that the contribution margin ratio was 30%. So everything that we see in this column here will be percentages. So here's the way this works. Sales is always 100%. Sales, if we're working backwards, are made up of two components in terms of our contribution margin income statement. Variable costs and contribution margin. What do you mean? Well, I usually take my sales and I subtract my variable costs to find my contribution margin. If sales are 100% and contribution margin is 30%, that means my variable cost has to be the difference between those two. If we were just looking at a straight contribution margin income statement without any of the percentages there, I could add together variable cost and contribution margin and arrive at my sales numbers. We're going to do the same thing here. We're going to use this to help us fill in the missing information. So when you are first presented with a problem like this, the problem will not tell you that sales is 100%. You will have to know that your starting point is sales of 100%. So 100% minus 30% is simply 70%. So to find my variable cost, I can take my sales of 1.2 million and multiply that by the variable cost ratio of 70%. Now, in theory, I should be able to then take my sales and subtract my variable costs to find the contribution margin. But wait a minute. We were told that the contribution margin ratio was 30%. 30% of what? 30% of sales. So if I take 30% and multiply it by 1.2 million, I should still get that same 360,000. Let me do that just for fun. 30% times 1.2 million, boom, 360,000. Contribution margin is 360,000. So do you have to take that extra step? No, I'm just proving to you that all of this works together. Now, at this point, even though I'll have some additional percentages because we're looking at everything as a percentage of sales, I won't necessarily need those percentages to help me find my amounts. Why? Well, I already have my contribution margin, add in my single underline, and fixed costs of 60,000 were given to me. And contribution margin minus my fixed costs will give me my operating profit. When we get to the percentages part here, remember that everything is expressed as a percentage of sales. So in theory, this is all going to work out. All right. Oh, I put it in the wrong place. Let me move that. There we go. I can go ahead and put my single and double underlines here. All right, so fixed costs, I can take 60,000 and divide it by 1.2 million, and I get 5%. So 30% minus 5% should be 25%. So my profits are 25% of sales. Let's double check that. 300,000 divided by my sales again of 1.2 million. And good, we get 25%. So notice with the percentages over here, we're just doing the same thing that we would do on a normal contribution margin income statement. We're still subtracting fixed costs from our contribution margin to find our operating profit, but just in percentages. All right, now that we have seen the process for Dennis's Retail Mart, when we get to Oakfield Convenience Store, things are going to go a whole lot faster. Now, for Oakfield, it looks like my columns are a little bit too big. Let me make that smaller. Let me go ahead and format this as a percentage and format this as... Now, Oakfield has the same amount of sales as Dennis, but that does not mean they're going to have the same profits. It all depends on their makeup of variable costs and fixed costs. And Oakfield definitely had more fixed costs and a higher contribution margin than Dennis. Let's see how that ultimately impacts an increase in sales later on. For right now, with composition, for composition purposes, we'll be all good and profits will come out exactly the same, but a change, and this is done basically for demonstration purposes, so that you could see a change in profits doesn't necessarily equate to the same impact. Or excuse me, a change in sales doesn't necessarily equate to the same impact on profits when you have two companies that look virtually the same for sales and profit. Just a different makeup of variable costs versus fixed costs. So let me stop talking. Let me enter in numbers so that my words don't confuse you, because I'm getting ahead of myself. All right, 1.2 million and 100%. That's my starting point. My variable costs, I don't know. But I do know my contribution margin ratio. I don't even know my contribution margin in dollars. That's okay. But we were told that Oakfield has a higher contribution margin of 70%. And fixed cost, I know my fixed costs were 540,000. Now, if I know my contribution margin is 70% and contribution margin plus variable cost equals sales of 100%, then my missing amount is 30%. I can then use that 30% and multiply it by my sales, because when we're looking at this percentage, it's all about a percentage of sales. That's why it's 100%. I take 1.2 million and divide it by 1.2 million. But for variable cost, I'm going to take the 1.2 million and multiply it by the variable cost percentage of 30%. And now that I know my variable costs and my sales, I can take the difference between those two to find my contribution margin. So notice, we just flip things around here. Take a look at it. Contribution margin for Oakfield is 840, but that's the variable cost for Dennis. Contribution margin for Dennis was 360, but that's the variable cost for Oakfield. We just switched around the percentages. Now for fixed costs, ooh, let's see what's going on with fixed costs here. For fixed costs, my percentages end up changing. So I'm going to take the 540,000, still dividing it by sales because everything is expressed as a percentage of sales. And notice that my fixed cost percentage is 45%. But I'm still going to do the math the same way for profits. I'm going to take my contribution margin and subtract my fixed costs for both dollars and percentages. That's 70. And notice we get the same profit. How? We just played with the numbers. So it would perfectly work out this way so that, again, you could see how things change based on different cost structures. All right, so let me add in my borders here so that as you're looking at this, it makes a little more sense. And this one is a top and double bottom border. All right, so we're all done with A. Now let's look at B. Suppose that both companies experience a 20% increase in sales volume. How much would each company's profits increase by? Well, in order to do this calculation, we need to calculate something called operating leverage. And we're going to put the formula over here to the right. Operating leverage is equal to the contribution margin divided by operating profit. Now, initially, when we do this calculation, we're going to get a number like 2, 1.8, something like that. And it literally is not going to mean anything from the standpoint of just looking at that number. It's an indication of how sensitive the company's profits are to an increase in sales. That number becomes more meaningful when we take into consideration that 20% increase. So let's find the operating leverage for both Dennis and Oakfield. So I take my contribution margin and divide it by operating profit. And of course, I'm going to have to increase my decimal here because I'm pretty sure that didn't come out to 1. There we go, 1.2. And then we're going to do the same. I know I could just copy the formula, but I want you to see it again. Contribution margin divided by operating profit. And I know that's not a perfect 3. There we go, 2.8. The larger the operating leverage, the more sensitive a company's profits are to an increase or decrease in sales, or even to any type of change in sales. And we know that companies with a lot of fixed costs are more sensitive to increases and decreases in sales. You probably heard the example, if you looked at the lecture video, of utility companies. If demand happens to increase, they have a huge profit to show as a result of that because they have a lot of fixed costs and looking at all of their infrastructure costs. But if you look at a store like Walmart, with all the retail items that they're dealing with, they have more variable costs. So if they have an uptick in sales, yeah, their profits will increase, but it definitely won't be as much as the same percentage increase for a utility company. So let's see what the percentage increase would actually be. So we're going to take the operating leverage and multiply it by a percentage increase in sales to see what the percentage increase in profits would actually be. Oh, in profits. So 20%, that was given to me. Oh, I should have this in here like this. And then let's make this a percentage. And then once again, the 1.2 times the 20%. And I got all excited I forgot to format it as a percentage. So what does this mean? If we increase sales by 20%, we're going to see a 24% increase in profits. You can do an entire contribution margin income statement and confirm that this 24% is actually going to happen. Or you can, in order to find the number, I should say, in order to find the new operating profit. Or we can just simply use the 24% increase in profits dealing with our old profits and find our actual new amount of profit. Let's do the same thing for Oakfield. It's still 20%. Make that a percentage. And we'll take the 2.8 times the 0.2. And I forgot to make this a percentage again. Oh, 56%. More sensitive, more fixed costs. And higher contribution margin is really what it is. That higher contribution margin represents more to be able to cover our costs. And because those fixed costs are fixed, once we know that number, as long as we have enough to cover our fixed costs, then we get to keep more, because the more our sales go up, the variable costs aren't going to go up as much. Now let's see the actual dollar increase in profits. And we can simply take the 300,000 and multiply that by the 24%. What did I do? I don't know what I did. Oh, I hit the wrong thing. I need to change that, not B20. That should be C21. So the 300,000 times 24% gives me an increase in profits of 72,000, or 372,000 would be the new operating profit. And then here, 56% times 300,000. 168,000. So you can see how useful the contribution margin income statement is, not just from the standpoint of break even, but also from the standpoint of analyzing a percentage change in sales volume through the use of operating leverage. All right, I hope this video was helpful. Hopefully you're able to dive into your homework. If you have any questions, please reach out to me. I appreciate your time and attention, and I hope you have a wonderful day.